Today's question that I want to ask you is, what has been your rate of return over the years, and is it competitive with the respective benchmarks? That's a technical ass question, but it's simple when I break it down to you. So, what has been my rate of return? Let's take that chunk of the question. My rate of return is a percentage that is a measurement of the gain that I've received on this investment. So it's usually it's measured over a period of time. So usually, the last month, the last year, the last 5 years, the last 10 years, the lifetime of the investment. So some mutual funds go back 50 years, 30 years, or something like that. And you can look at, well, if I had $10,000 in this fund at the inception, is what it'll be called. So when you look it up, I recommend Yahoo Finance as a good place to do research. And when you look up a certain stock symbol, when you're looking at the historical rates of return, when you see the word inception, that means the beginning of this fund. It started on this date, or a particular stock. It didn't exist on the exchange until this date, its inception, and then it'll break down. 30 years, 20 years, 10 years, 5 years, so on and so forth. You may even be able to pick a range that you want to measure. So, what has been my rate of return over the years? So, the time horizon is over the years. That years could be month, whatever you want to judge it by. The last 52 weeks is what always comes up when you're looking at the chart, and that's just looking at the last year. What's the rate of return over the last year? And so that rate will be, for instance, 5.2. That means you got 5.2% return on my investment over the last 52 weeks, or the last 5 years, or the last 10 years, or 20, 30, or since inception. You'll see that. Since inception. Since this fund began, you would have gained X% return. And that's probably going to be very high in comparison to the month. Because if you had this thing since it first started, you might see, well, I would have had 35 or 55% return, or X many 100% return. But over the last month, you might see 2% return, negative return. But even over the 52 weeks, it's going to be a different measurement. They're answering different questions, and those different questions are all different, meaning how does it pertain to your financial circumstance. So, what has been my rate of return over the years, and is it competitive to the respective benchmarks? Benchmarks are the things like the Dow Jones Industrial Average, the Standard & Poor's 500, S&P 500, you might have heard it, the NASDAQ. Those are all lists of a certain group of companies that represent a certain sector of our economy and our GDP. So the theory is that if those averages, those indexes, so for the Dow Industrial Average is an index. It's the average return of these companies, these 36, I believe it is, companies that represent our gross domestic product of this United States. So if that Dow goes up, the theory is our GDP, our businesses, our U.S. economy is up. If that average is down, our economy is down. The same with the NASDAQ. NASDAQ is sort of a focus on tech related companies, or the newer, I would call them more vibrant, robust, nimble sort of companies. It's not always the case, but theoretically it's the case. That's a description of the companies that are on the NASDAQ. But point being, they trade on the NASDAQ exchange. And so those companies, when you see the average up or down, that is telling you that if it's down, there's more sellers than buyers. If it's up, there's more buyers than sellers. So that's a judge of how your stock is doing. And so those benchmarks over time, we can see how they've been doing. So the theory is, if your investments are, let's say the benchmark is 7%, right? And I'm going to explain that to you in a little deeper in a second. Let's say the benchmark is 7%. That's saying that the market is receiving 7%. Now your investments are receiving 6%, right? Let's just say hypothetically. So against the benchmark, you're down. So you're not doing as good as them against the market. So point being, well, shit, I could have just put my money in a fund that matches the benchmark, matches the market, and I would have been doing good. But I'm trying to beat the market by doing all this slick investing that you're doing on the side. So all this here slick stuff you was doing, this theoretical, oh yeah, I think I'm gonna buy this stock. They, like you heard, invest in the things that you know, right? Invest in the things you buy. So now you want to buy Nike because you buy Nikes, right? Nike ain't moving because Nike is a big company. So you did that. Now compare your rate of return since you bought Nike. I don't even know what Nike is selling at, but let's say hypothetically it's selling at $100 per share, and it goes up to 101. So, so what's that percentage? It's low versus that market is going up. The market went up 7%. So you didn't even match the market. So you was wasting your time on that strategy. That's what it means. Now, let me go back to that though. That's not exactly true, because you also have to judge how you're doing your rate of return against the benchmark by your risk tolerance, because your risk tolerance is such that I'm not trying to beat the market. In fact, I'm not even trying to play the market. I'm a little more conservative than that. I want to ensure, because the market go up and down like this here. So you can't even take that. You like, look here, I know it's not gonna go here. So yeah, the market doing all of this right there, but you just gonna steady and slow, never mind what the market doing. You guarantee you invest in bonds giving you a steady rate of return. You say, so the market is at 7, you say, you know what, that's a 7 average. That means it could have been up 10%, but it could have been down to, let's say somewhere like about 5%, right? And so you've been getting that average of 7 somewhere in the middle. But the person who invested in bonds, they don't want to worry about it. They're just getting their consistent amount. It's going to be low, but you are experiencing the risk reward trade-off. And so that's when I say measuring against the benchmark, but you also have to consider your risk tolerance, risk reward trade-off, right? I can't tolerate that much risk. Okay, so I'm not going to receive that much reward. because it's a risk-reward trade-off. So since I can't if I can tolerate a lot of risk, I'm gonna accept this much risk, but that means I got the space for this much reward, probably even higher, because I'm risking more. So those are the factors for us to measure how to answer this question. What has been my rate of return over the years, and is it competitive with the respective benchmarks? These are questions that, hey, if you want to get serious about your investments, if you want to achieve your goals, you got to be able to answer the question. And so that means you got to hire somebody like me, or you actually have a financial advisor. You have financial people working for you. You got 401ks. You got old IRAs, old 401ks that from old jobs, old funds that you had, old investments that you had somewhere. So wherever that's at, that when that job that you left and that 401k that's at that job is with Schwab or some other company, whatever company it's with, there's a representative there that you need to be calling, and you need to get answers to these questions. Now, but what you gonna do with the answer, right? So now they're gonna give you an answer, and now you even gonna have to say, okay, well, how do I improve that? And they probably can't really talk you through this question because you're not paying them nothing. But I got a way for you to answer this question. Some of the free tools that our firm offers are a financial planning evaluation. It's an assessment. If you go to my website and or just send an email to account support@hoodoofinancial.com. That's I'll edit and put this stuff up on the screen. But basically, these are some financial tools financial calculators allow you to crunch some numbers, just in general on your own before you have to reach out and ask, a professional question for me, spend some money or at least ask a question and get started. But hey, in general, what I'm telling you, that if you do have some of those old accounts, old 401ks and IRA accounts at other institutions, roll those accounts over with somebody who cares to work with you and help you out on this. And that's me. So roll it over to our firm. And you roll it over, I'll answer the question. I can give you a report to tell you this is how good you're doing. And I'm going to ask you the questions. In the tools that I'll send you is a questionnaire that's going to we're going to establish your risk tolerance and your risk profile, and we're going to find out what you're trying to save and invest for. What are your goals? What you're trying to achieve? And then I'll show you how we can get there. You can do it or not, but I'll show you this. You want this and that. Okay, this is going to cost you X, Y, and Z. So how you don't have a plan? Well, here's what it's going to cost you to get there. Here are some of the assumptions we're making. Some of the assumptions are this rate of return. So we're going to look at the rate of return you've been getting. And so if we find out, you've been getting around 6%. Well, inflation is 3%. So your money is steadily being chewed away. So then the net there, 3%. So roughly you've been gaining 3%. Your money been working for you, making 3% more every year. Because if it was getting 6%, now it's inflation is chewing away at that. So we got factors that you need to work. Little do you know, it's factors conspiring against you. So you need someone like me. I'm just sounding an alarm to those who need the help, who I want to help. That regardless if you recognize it or not, these are the things that for you to get ahead, you're going to have to do. And you got somebody in your corner right now that's willing to step up and help you do it. I got the tools. I speak Ebonics, so I speak economic Ebonics. I can break it down to you. So if you want to change, if you want to do better, you can do better. I'm putting the information on the screen for you right now. So thanks for listening. We'll talk later.